Welcome to the Ultimate Stock Finder by Sorensoft. Our free stock evaluator spreadsheet helps us find companies with strong balance sheets that have growing sales and profits, but have stock prices that may be unreasonably low. We look at several industry standard ratios to confirm that a company is in good financial health, so we can buy with confidence when the stock price becomes too cheap. Price to earnings ratio, or PE, is stock price in dollars per share divided by annual earnings or profit dollars per share. Historically, stock markets average a PE of 15, but in bull markets, where everyone thinks the stock prices will continue to go up, PEs can average above 20. And in bear markets, where everyone thinks stock prices will continue to go down, PEs can go below 10. We believe that a PE below 15 means a company may be selling too cheaply. Price to sales ratio is stock price in dollars per share divided by annual sales in dollars per share. We believe that a PS less than 1 indicates a stock may be underpriced. Price to book value is stock price per share divided by book value per share. Book value is the total value of the company's assets that shareholders would theoretically receive if a company were liquidated. This is also called total stockholder equity and includes both physical assets like buildings, inventory, and machines, and also intangible assets like patents and customer goodwill. A PB less than 1.5 is good. Debt to equity ratio is long-term debt divided by shareholders' equity. Shareholders' equity is total company assets minus all liabilities, including short and long-term debt and accounts payable. Debt to equity varies between different industries, and though we like to see it below 50%, there are some machinery-intensive businesses like power plants and auto manufacturing where it may still be reasonable at 100%. Goodwill is assets of the company that are intangible and not real physical things. This includes patents, customer goodwill, and trademark value. As such, these goodwill assets may have no value if the business climate changes. A high goodwill to equity ratio can indicate that a company has been increasing its sales by buying its competitors and paying more money than the buildings and equipment are worth. We prefer that goodwill to equity be less than 25%. If the company pays a dividend, the ratio of yearly dividend dollars per share should be less than 50% of the annual earnings or profit dollars per share. This provides a cushion to protect the dividend payment if there is a year with lower profits. When companies lower their dividend payment, their stock price goes down. Another important value we use to determine a company's financial strength and its ability to recover from market downswings is profit margin. A company that is making a profit will come back from market downswings much faster than one that is losing money. Profit margins as low as 2% are still very good in today's economy. Just look at what your savings bank is paying you. Companies that pay a dividend are paying you to wait, so you can be patient if you buy them and have to wait for them to go back up. Remember that with today's poor bank interest rates, a dividend-paying stock can be better than money in the bank. Enterprise value divided by revenue is one of several Warren Buffett-inspired ratios that we like. This ratio will be explained in detail in another video. We like it to be less than 1. Enterprise value divided by EBITDA, also to be explained later. We prefer it to be less than 6. The first thing that will drop a company's stock price is when their revenues go down compared to last quarter. Even a small revenue growth rate of 2% per year is normally enough to keep a stock out of trouble. Insider ownership is a no-brainer. If the people who work at the company own the company, they will do everything possible to keep that stock value up. Even a 5% insider ownership stake is huge compared to most companies. Walmart has 49% insider ownership. Target has less than 1%. Be sure to do your homework on this. Another Buffett value is profit margin percent plus dividend percent divided by price to book value. We like it to be greater than 10. Stock Evaluator contains all the fundamental company ratios and values that we track and allows you to input your target for each value. When your target is not met, the text in the cell for that company turns red. Also, check our links pages for web links to the free websites we use to research company facts, market data, and to do personalized stock searches. Stay tuned to Ultimate Stock Finder on YouTube for more videos explaining each of these investing terms and how the ratios are calculated. Until next time, we at Ultimate Stock Finder and Sorensoft wish you the best of goodbyes.